This will be a brief demonstration of the Tariff Impact Calculator that I recently built into the valuebridge.net website. It is designed to help you either predict or explain how various tariff-related factors will change a private equity investment's fair market value. To start, you'll need to plug in 3 capital structure metrics: the GP or fund's equity value, total shareholder equity, and net debt. 3 income statement metrics: revenue, gross profit, and EBITDA, and optionally the prevailing market valuation multiple for your industry or sector. Then you can go up to the top and start twisting dials to see what happens to your equity ROI. For example, let's say that tariffs increase the average unit cost, and then we respond by increasing prices. But this causes the company to sell fewer units. Perhaps there's also a modest change in SG&A, and then, due to uncertainty in the M&A environment, broader market valuation multiples go down, and so does the company's valuation multiple. Right here, we can immediately see how these factors impact the return, and when you scroll down to the bottom and select the model, you generate a value bridge that quantifies all the sources of value change. They include pricing, volume, gross profit margins, operating expenses, market multiples, the company's relative valuation, gearing, which is how much debt on the balance sheet has amplified equity gains or losses, and cash flow generation. Below the chart, we have a table with absolute dollars of value creation for each value driver. And then we have relative value creation, which is the percentage of equity value change. Below that are equity return multipliers, which combine to produce a multiple of invested capital. Then we have an annualized return measurement that works like an IRR. And finally, there is times money value creation, which is a measurement that's sometimes used in academic and industry studies. If we wish to save this analysis with all of the inputs and outputs, we can click right here to print to paper or PDF. Now, you can use this model to predict future equity values, but the results will only be as accurate as your predicted assumptions. I think that it'll be far more meaningful to do this analysis about a year from now when you can look back at real changes in portfolio company financials. This will provide an accurate explanation of how tariffs have challenged the company, what you did to respond, and how those efforts flow through to equity ROI. That's something that I think might fit very nicely in an annual meeting presentation or a fundraising deck.